Hi guys, welcome back. Let's talk about Credit Suisse as there's more things unfolding in the banking industry. Credit Suisse has an asset value of $531 billion, while SVB, the bank that just collapsed last week, has assets of $209 billion. So Credit Suisse is over 2 times bigger, and it is even 5 times bigger than the Signature Bank, who also collapsed last week, which if you put it in the US market, it would put Credit Suisse as the 8th largest bank in the United States. So we have all heard the term too big to fail, but people are labeling Credit Suisse as too big to even be saved. And this is why it's scary, is because it's showing us the banking crisis isn't just limited to the smaller banks inside of the United States like we once first thought. And people are warning if this is the start of something much worse. After all, the 2008 housing crisis had to begin somewhere, and Michael Burry is once again quick to shout alarms about the upcoming crisis. Hi, my name is Austin and I have a degree in finance, and today I'm going to be explaining what's going on with Credit Suisse, why their stock is down 25% and 40% this month, and what the implications could be if it were to fail. So Credit Suisse is an investment bank in Switzerland with $1.5 trillion in assets under management and $531 billion in assets. So by no means is this a small bank, as it's in the top 50 banks in the world. In other words, this bank is quite possibly too big to fail. And this situation is one that you're going to probably want to pay close attention to, since it doesn't only affect the United States, it actually has large implications for the world economy. So I want to break this down as simply as possible. This has been a long failure in the making, actually. Credit Suisse has been failing for a long time, and investors know that. That is why the stock has been declining for the last 10 years. So by no means is this a stock that people even want to touch or they want to put their money at. And people recognize when it's a good time to cut their losses. And that's exactly what the Saudi National Bank said this morning. Credit Suisse has been hit with compliance failures and mistakes that have led them to lose a lot of money and lost market share. This has damaged their reputation, and they have lost a lot of customers because of this. In fact, customers had withdrawn $133 billion from Credit Suisse just last year. Well, the Saudi National Bank stepped in to fund the bank to a tune of $1.5 billion to take over as the largest stakeholder. At the time, Credit Suisse was losing around $8 billion a year. In October, the lender brought on radical restructuring plans by cutting 9,000 full-time jobs and trying to relabel the company as a wealth management company. They essentially thought that they could just come in, make some big changes, and they'd be running a highly profitable bank. Easy peasy. Well, shocker, things did not go in their favor, and they basically have decided to cut their funding for the bank. Now, a reason why they kept trying so hard to keep the bank going is they had already put so much money into the bank. They basically saw that bank as a large investment for them. But it seems that they have understood that despite their best efforts, it still isn't working and the bank is still losing money. They announced just yesterday morning that they will not be providing any more money to the bank to keep the bank afloat. So this means that they will be recognizing a sunk cost, which basically means that they know that the bank is in such a bad position that it's cheaper for them to let the bank go than to keep pouring money into it just to lose more money every single quarter. This is essentially why the stock was down 25% yesterday, and everyone is freaking out because it seems like this bank may never recover. So it was thought that the financial crisis was over, but nope, it looks like one of the biggest banks could be on the brink of failure. And this has a ripple effect in the European financial sectors as well as the US. After all, contagion is a big problem when banks have catastrophic issues. And this is pushing everyone to the edge. So that makes me think that this is like Jenga. It's when the last brick is pulled, everything could come crashing down. Now, that may be a little aggressive, but we ultimately don't know what's going to happen. And people like Michael Burry are saying this is feeling like the same as the 2008 financial crisis. Now, to go off on a little tangent here, this is probably going to change how the interest rates work here in the US. The Fed is paying close attention to the banks that are collapsing here, as well as the ones that are collapsing overseas, and they really don't want to see people lose faith in the banking system, as this would spell disaster. Well, banks have harder times making money when interest rates are higher, so the Fed is probably going to have to pause increasing interest rates and even decrease rates just to make sure that the banking system is safe. And now the bond market is pricing in some significant interest rates drops just by the end of the year. So we kind of have to hope that the inflation isn't going to start kicking back up just because of decreasing interest rates. Okay, so back to Credit Suisse. Just to show how bad of a position Credit Suisse is in, I want to take a look at the credit default swap rates. To make credit default swaps as simple as possible, you got to think of them as an insurance policy in case of a worst case scenario for the bank. Just like car insurance, if you're more likely to get in a car accident, you're going to probably have to pay a higher premium. And if you are less likely to get in a car accident, you're going to pay a lower premium. So let's first take a look at JP Morgan. This is one of the biggest and quote, safest banks in America and has a credit default rate of 98.17. And this is not a bad number, but it's much higher than normal. But compared to Credit Suisse, it looks really good. And Credit Suisse has a 10 times higher premium and a 100% increase just today. And honestly, that is absolutely crazy. It seems that no one wants to touch Credit Suisse. Their stock price is absolutely falling, and they just lost their main investor. So things don't look good for them, and people are worried. People are worried that if the contagion will spread to other markets and other banks. So to call the future uncertain is an understatement. Now, if you found this video helpful, please give it a like and help it reach more people. Subscribe to stay in the loop, and if you find yourself ready to invest in the stock market, please use my link below. It helps me out a lot because I don't get paid. Okay, so some new news came out and it brought share prices back up. But this video is still relevant, okay? The Swiss National Bank just said that they would offer a loan for $54 billion. They said this because Credit Suisse was one of the banks that are requiring higher capital and liquidity because it is one of the most systemically important banks. Otherwise, we know this as there is too much risk to let this bank fail. To make a long story short about this quote bailout, they're doing this because they're afraid of a bank run and they need people to be more confident in the banking system. But if I'm being honest, I think they're just kicking this problem down the road. So people with accounts of this bank, this is a warning, and a warning for an upcoming doom of Credit Suisse. All right, I think it was helpful. Please like it. See you on the next one.